Hey everyone, welcome to your Algo Lab. Today we're diving into backtesting, one of the most well-known long-term indicators out there, the 200-day moving average. This simple yet powerful tool helps us gauge long-term momentum. Here's the basic idea. If an index's level is above the 200-day moving average, it's generally seen as bullish, meaning the price is likely to keep rising. On the flip side, if the price drops below this moving average, it signals a pause in the bullish trend and the start of a bearish one. Using this long-term trend indicator can help us identify positive trends and avoid downturns, making our investments not only more profitable, but also less risky by steering clear of bear markets. Without further ado, let's get started. Backtesting long-term signals can be challenging because traditional backtesting methodologies don't work well on long-term indicators due to the limited number of signals triggered. To overcome this, we look for commonalities across different markets, which helps guide us in selecting reliable indicators. In this episode, we'll be examining equity indices from around the globe. In later episodes, we'll explore other asset classes as well. From the United States, we have the S&P 500, the Nasdaq, and the small cap Russell 2000. Moving to Canada, we have the TSX Composite. In Europe, our focus will be on the Euro Stoxx 50, the German DAX price index, the French CAC 40, Spain's IBEX 35, Italy's FTSE MIB, and the Swiss SMI. In Asia, we'll examine Japan's Nikkei 225, the Hong Kong Hang Seng Index, and Australia's ASX 200. We've collected daily data starting from 1980. For indices that began trading after this date, we've used the earliest available historical data. Let's set up our benchmark. Our benchmark will be a buy and hold strategy on equity price indices. We've chosen price indices because reinvested dividends can distort the calculation of the long-term moving average. Here are the benchmark buy and hold returns. For example, the benchmark buy and hold return on the S&P 500 would be 9.00%. Just a quick reminder, this is the price return without including reinvested dividends. Returns are just one facet of an investment. We also need to consider risk. Our preferred measure for this is maximum drawdown, or MDD for short. Maximum drawdown is used to assess the risk of an investment by representing the maximum observed loss from a peak to a trough in a portfolio before a new peak is achieved. In simpler terms, it shows the largest drop in the value of an investment from its highest point to its lowest point. Here is our table of maximum drawdowns for the buy and hold strategy. For example, during the testing period, the S&P 500 experienced a maximum peak-to-trough loss of 56.78%. The Nasdaq saw a peak-to-trough loss of 82.90% during the dot-com bubble. Now, let's set up our test strategy, a long-only strategy based on the 200-day moving average. Here are the rules. We will buy the stock index if it crosses and closes above the 200-day moving average. The buying price will be the next open price following the close above the 200-day moving average. We'll close the position if the index crosses below the 200-day moving average. A commission of 0.2% is included in the calculation to account for the cost of trading. Let's put the 200-day moving average strategy into the code to test and see if it can beat the buy and hold benchmark. We'll compare the results directly against our benchmark to see how they stack up. Here's our table comparing the buy and hold benchmark with our 200-day moving average strategy. We've highlighted the stats where the 200-day moving average outperformed the benchmark for clarity. For instance, with the S&P 500, the 200-day moving average strategy didn't outperform the benchmark in terms of return, but did achieve a smaller maximum drawdown. Overall, while the average indices underperformed in returns, they effectively reduced the maximum drawdown. Why does the 200-day moving average not provide higher returns? One reason is the number of false or losing signals. In a choppy market, the price fluctuates around the 200-day moving average, leading to false signals and losing trades. The win rate of the 200-day moving average, or the percentage of winning signals out of the total signals, is only 27%. These small losing trades diminish the profits from the few winning trades. Most of the 200-day moving average strategies underperformed the benchmark in terms of return. But what about risk? When it comes to risk, the 200-day moving average strategies generally improved the maximum drawdown. This makes sense because they avoided the most extreme periods of bear markets. So how do we account for both return and risk? We introduce a risk-adjusted measure, the maximum drawdown adjusted return. The MDD adjusted return is the ratio between the annualized return and the maximum drawdown. While it is not the only risk-adjusted measure, it is simple and effective. Here we see that the 200-day moving average performed better in risk-adjusted return for most of the indices. This consistency is what we're looking for, as we want an indicator to be effective across similar assets. But we're not stopping here. In the next episode, we'll explore a simple grid search to see if we can improve our 200-day moving average strategy. If you like our channel, make sure to like, subscribe, and hit the bell icon to stay updated with our latest content. Thank you for watching, and see you next time.